Today we will deep dive into why the waste sector is such a stable and attractive sector. Despite its lofty valuation, what exactly waste management and peers do, how they establish such a monopoly-like pricing power and can stabilize your portfolio in the current volatile market phase. Now you might ask, why are waste management stocks so attractive at the moment? They offer historically stable growth, low competition due to complex recycling, low impact by artificial intelligence, and most importantly, immunity to tariffs and growth potential through an energy twist. We all produce waste, whether it's Monday or Sunday, we work or on vacation, we are young or old. We all live and produce waste. And exactly that's the beauty of this sector, its stability and reliability. Even dramatic external shocks like the 2020 pandemic or the financial crisis did not stop the flood of waste. But companies like WasteManagement, Republic Services, WasteConnections, GFL Environmental, and Casella Waste Systems not only collect the trash, but also recycle its resources. Their pricing power and growth are driven by one simple factor: demand is outpacing supply. Meaning even if the waste volume is kept steady, the supply of landfills and its capacity declines. The US currently has around 1,265 open landfills, of which roughly 50% are closing by 2050 due to reaching capacity. That's why even if trash demand is kept steady, we see reasons for price increases due to a supply and demand imbalance. Especially the northeast of the US will be hit hard, with the highest population density and lowest open landfills. This will result in even more exports to other regions and probably increase the cost even further and justify price hikes even outside the northeast area. Meaning newly added landfills are scarce due to high regulatory hurdles and demand for more sustainability. Important to note that this sector is a very capital intensive one, increasing the barrier to enter the market for new players. Let's take a look at the value chain of waste management stocks to see how much value your trash offers. First, the obvious. Trucks collect garbage from residential, commercial or industrial customers with their fleet and charge a fee for their service. Second, the truck can deliver to 3 different destinations: the recovery facility, a transfer station or the landfill. In all cases, a fee is due, which marks the second layer of the value chain. And third, the recycling facility and the landfill use the trash to monetize it further. While the recycling facility directly sells recycled paper or compost, the landfill captures methane, which is processed into renewable natural gas, or short RNG. The RNG can be monetized twice, once by selling it and second by generating RNI credits, which can be sold to companies producing conventional energy. The RNG can also be used to run the trucks, which collect the garbage, reducing costs and the carbon footprint of the fleet. Regarding waste production in the US, the reputable Waste Business Journal indicates an annual growth of roughly 1.2% for municipal solid waste. Even though demand is only growing slightly, the supply will change, as we discussed earlier, leading to a great opportunity for established waste stocks. Since all US waste management stocks are trading at high valuations, it makes sense to choose the best vertical integrated one. This is crucial since the disposal cost, meaning the cost for dumping the trash from the truck to the landfill, are often at least 30% of the total value chain. If the company owns the landfill, it can earn and optimize the value chain and even profit from others. This chart shows that Waste Management owns 28% of the US landfill's capacity and Republic Services 20%, both marking the largest chunk of privately owned landfills. GFL and WasteConnections only account for 4% and 8% respectively. Therefore, Waste Management and Republic Services have a clear advantage over the other waste management stocks. Of course, such an opportunity at Wall Street comes at a price. The big three all trade at PE ratios above 30, and even smaller upcoming waste management stocks like GFL have extremely lofty valuations. Hard to enter as an investor. Besides their trading valuation, it's important to compare the depth of each company, since the waste segment is a very capital-intensive market. Therefore, it's vital to track the so-called debt-to-EBITDA ratio closely, which divides the total debt by the earnings before interest, taxes, depreciation, and amortization. This metric enables us to compare waste stocks by debt, implying a higher risk for investors. Waste Management is at 3.4, Republic is currently at 2.6, WasteConnections at 3.5, GFL at 3.7 and Casella at 3.2. So Republic seems to shine here. As promised earlier, each of the 5 stocks has an energy twist, as they all use the waste to produce renewable natural gas, which is an essential commodity not only as an energy source but also for the petrochemical industry to produce base materials. The base materials are ethylene and propylene for laundry detergents for Procter & Gamble, PET bottles for Coca-Cola, nylon textiles for a new sports outfit from Nike, Hoka, On or Lululemon, and cosmetic ingredients for Sephora and Dove. Additionally, the demand for RNG is surging in the coming years, even if the sustainability importance softens. The hunger for energy is still high, as this study suggests it will increase with a CAGR of 8.3% per year. Just a few days ago, Meta announced a 20-year deal with Constellation Energy, which let Constellation stock surge the day. Even though the gains faded away the days after, it signals the huge demand of Silicon Valley to power its data centers for the coming decades. Despite lofty valuations, the waste sector might be an attractive addition for mid to long-term investors seeking stability and growth even if trash demand is shrinking. Highly vertical integrated stocks like WasteManagement and Republic can be valued as small energy stocks due to RNG production. In combination with the Big Five's PE ratio ranging from 30 to 116, at least WasteManagement and Republic Services are candidates for a buy if we enter recession territory and both stocks fall below PE ratios of 30. Thanks for watching and see you in the next video.